Hello everyone, thanks for joining us today. Today, we're diving into Coca-Cola, not just as a drink, but as a global business that millions invest in. It's a brand recognized in nearly every country, and its financial health impacts people all over the world. When you own Coca-Cola stock, you own a piece of the company, so its performance matters to you. Every share represents a stake in its future, making its success or struggles personal for investors. Sales reports are like a business report card, showing strengths and weaknesses worldwide. They reveal how well Coca-Cola is doing in different regions and help us spot trends over time. Investors use these numbers to decide, buy, sell, or hold. These decisions can affect the company's stock price and even its future strategies. The fourth quarter, October to December, is crucial because of holiday sales. This period often brings a surge in demand, making it a key time for the company's yearly results. Recently, Bank of America analysts shared their predictions for Coca-Cola's Q4 before the official numbers come out. These insights are highly anticipated by the investment community. These expert forecasts give investors an early sense of what's happening. They help set expectations and can even influence market reactions ahead of earnings reports. We'll break down what these analysts are saying, what the sales numbers mean, and why they're still optimistic about Coca-Cola's future. Understanding these details can help you make smarter investment choices. Think of it as detective work, piecing together clues to see the bigger picture. Each report and forecast is a clue that helps us understand the company's direction. By the end, you'll understand what's really going on with this iconic company and why its sales matter to so many people around the globe. So, what's the news? Bank of America analysts have updated their forecast for Coca-Cola's Q4 sales. They now expect sales growth to be about 1%, down from their earlier 1.5% estimate. Unit case volume, which tracks how many drinks are sold, is the key metric here. Even a small change matters for a company as big as Coca-Cola. A 0.5% drop means millions fewer drinks sold. This signals a slight slowdown in sales momentum at the end of the year. For investors, even minor shifts in these numbers can be significant. Analysts use this data to adjust their expectations for the company's financial health. It's the first clue in our story. Why did they lower their forecast? Let's dig into what's behind this change. Understanding these details helps investors make smarter decisions. Let's see what the data reveals. Why the change? Bank of America's new forecast is based on scanner data, real sales tracked at checkout counters, not just company shipments or estimates. This approach gives a more accurate, up-to-the-minute look at what's actually happening in stores across the country. This data showed U.S. sales volume dropped by 2.3% in Q4, a significant dip for a brand as established as Coca-Cola. The U.S. is Coca-Cola's home and one of its biggest markets, so a decline here matters. When American shoppers pull back, the impact ripples through the company's global operations. Why the dip? Higher prices may have pushed some customers to buy less or switch brands. With inflation squeezing budgets, even loyal fans might reach for a cheaper alternative. Changing consumer tastes, like a shift to water or energy drinks, could also play a role. Health trends and new beverage options are reshaping what people put in their carts. The analysts don't point to one cause, but the 2.3% drop is a hard fact. It's a wake-up call for the company and the industry. This U.S. decline is the main reason Bank of America lowered its overall growth estimate for Coca-Cola. Even though Coca-Cola is global, a slowdown in the U.S. drags down worldwide numbers. The company's international reach can't always offset a slump at home. It's a clear example of how one big market can impact the whole company, influencing decisions at the highest level. The forecast change, from 1.5% to 1% growth, directly reflects these weaker U.S. sales, showing just how sensitive projections are to market realities. For investors, it's a reminder. Local trends can have global effects, and no market is too big to falter. But the story doesn't end there. Let's look at what's happening elsewhere. Other regions may tell a different story. Global companies must balance ups and downs in different regions, adapting strategies to local realities. That's why analysts watch every market closely, searching for early signs of change. The next clue comes from south of the border, where trends may look very different. Let's see how Mexico fits into the picture, and what it might mean for Coca-Cola's future. Here's where things get interesting. While U.S. sales slipped, Coca-Cola's sales in Mexico were strong. Growth in Mexico helped offset the U.S. decline. This contrast shows the power of being a global company. When one market slows, another can pick up the slack. Coca-Cola's presence in over 200 countries means it's not tied to any single economy. Strong demand in Mexico could be due to a healthy economy, great marketing, or local preferences. Whatever the reason, Mexico was a bright spot in Q4. This tale of two countries highlights the complexity of running a global business. Strategies must adapt to local conditions. For investors, it's a lesson. Always look at the global picture, not just your own backyard. Coca-Cola's worldwide reach helps keep the company stable. Let's see how these sales shifts affect the bottom line. When sales change, earnings are next in focus. Investors and analysts pay close attention to how even minor shifts in sales can affect a company's bottom line. Earnings per share, or EPS, shows how much profit the company makes for each share. It's a key measure of profitability that helps investors compare companies of different sizes. Because of lower sales, Bank of America trimmed its Q4 EPS estimate by just 1 cent, from 49 to 48 cents. This adjustment, though small, reflects the company's careful approach to forecasting. 1 cent may sound tiny, but with billions of shares, it adds up to millions of dollars. Even the smallest changes can have a big impact when scaled across a global company. This small adjustment reflects the slightly weaker sales outlook. It's a reminder that forecasts are always evolving as new information comes in. Still, it's not a major concern. Analysts expect Coca-Cola to manage costs well. The company's track record gives investors confidence. Updating forecasts as new data comes in is standard practice. It helps companies stay agile and respond quickly to changing market conditions. The fact that the earnings cut was so minor is actually reassuring. It suggests the company's core business remains healthy. It shows the company's profitability remains strong, even with softer sales. Coca-Cola's ability to maintain profits is a testament to its strong brand and efficient operations. For investors, it's a sign of solid management. Leadership that can navigate small setbacks is highly valued in the market. Small changes in sales can ripple through to profits, but Coca-Cola's scale helps cushion the impact. Its global reach and diverse product lineup provide stability. The company's fundamentals remain intact. Strong fundamentals are what keep investors interested, even during uncertain times. Now, let's see why analysts still recommend buying the stock, and what they expect for Coca-Cola's future performance. Despite softer sales and a slight earnings cut, Bank of America kept its buy rating on Coca-Cola. A buy rating means analysts see the stock as a good investment for the future. Why? Because they focus on the long term, not just one quarter. Coca-Cola's strengths, its global brand, vast distribution, and diverse product lineup are powerful advantages. A small dip in one quarter doesn't change the company's overall story. Analysts believe these strengths will drive growth for years to come. The buy rating is a vote of confidence in Coca-Cola's future. They see the current slowdown as temporary, not a sign of deeper trouble. For investors, it's a reminder to look beyond short-term bumps. The company's fundamentals remain strong. Let's look at what this means for the stock price. Along with the buy rating, Bank of America kept its price target for Coca-Cola at $70 per share. A price target is where analysts think the stock will be in about a year. Keeping the target unchanged signals confidence in Coca-Cola's long-term value. If the current price is $60, a $70 target suggests room for growth. Analysts set price targets by looking at future earnings, cash flow, and industry comparisons. not lowering the target, even after a small earnings cut, shows they see recent sales softness as a minor issue. They expect Coca-Cola's global business and brand power to drive the stock higher. For investors, an unchanged price target is reassuring. It means the experts still believe in the company's future. Now let's talk about Coca-Cola's own forecasts. Bank of America expects Coca-Cola's official forecast for 2026 to be conservative. A conservative forecast means setting cautious, achievable goals. Companies often do this to underpromise and overdeliver. If they beat their own targets, it creates positive surprises for investors. Coca-Cola may be cautious because of global uncertainty and mixed recent sales. This strategy gives management flexibility to handle challenges. For investors, a conservative forecast isn't bad news. It can set the stage for future upgrades. If Coca-Cola outperforms its own guidance, it could boost the stock. Savvy investors see this as an opportunity, not a disappointment. Watch for positive revisions as the year unfolds. Let's sum it up. Bank of America saw slower U.S. sales for Coca-Cola in Q4, but strong results in Mexico helped balance things out. They trimmed their sales and earnings estimates slightly, but kept a buy rating and a $70 price target. Analysts believe Coca-Cola's brand, global reach, and product diversity will drive long-term success. The recent slowdown is seen as a temporary blip. Coca-Cola's likely conservative forecast for 2026 could set up positive surprises later. For investors, the lesson is clear. Don't overreact to short-term news. Look at the whole picture, both the challenges and the strengths. Coca-Cola remains a solid, stable company with a promising future. Smart investing means focusing on the long-term story. Thanks for watching. Stay tuned for more insights.